Hello, friends. I hope all of you are fine. Myself, Sambhav Gupta. So, this is a third part of the second chapter of the financial instrument. Uh, so let's continue. So, till now, what we have covered. So, we have covered the business model and the SPPI test for the financial asset under the classification in the part one of the chapter two. And in the second part, we have covered the amortized cost, fair value through OCI, and the FVTPL under the financial asset. Yep. So now coming to the second main this thing. So second point. So first point was the classification under the financial asset, um, and under this one, the second point, the measurement. So here the initial recognition we will be discussing and the subsequent recognition. So starting with it, just a bit. I just need to flip to the study material. Okay. So here the financial asset measurement. So measurement of the financial asset is driven by their classification and can be broadly explained with the help of the following diagrammatic presentation. So this is the same thing what we have uh, done in the part two. So this is a repetitive one. So just quickly, I will be just going through. So in the initial measurement, what you are doing. So what I've told you that you will be recording the financial asset at the fair value. Okay. So normally the evidenced by the transaction price. So this is normally it is evidenced by the transaction price, means the transaction price, normally the price is equal to the fair value. Okay, and the transaction price is what? The transaction price is what the consideration the investor has given to buy that financial asset. So that is a transaction price. So normally the transaction price is equal to the fair value, but sometimes if the fair value is not transaction price, so then you need to take the fair value and um, the difference between the fair value and the transaction price that you need to account for, so that they are discussing. So those will be coming under the off market transactions, you can say. Okay, so where the part of the consideration is for the other than the financial instrument, then the entity shall measure the fair value of the financial instrument. Okay, so like here, if you are paying, the investor is paying for the investor is paying to buy the financial instrument plus for the other assets. So then you need to determine the value, fair value of that particular financial instrument. Yep. Okay. So this we will be discussing later, means in the coming pages. But yeah. So here the takeaway is that the fair value, at the fair value you need to record the transaction of the financial asset. Okay, in the initial measurement. Now in the subsequent measure, fair value measured at the amortized cost. So here the effective interest rate method will be coming. So fair value at the initial recognition. So the whatever the fair value, this I wrote also in the last lecture. So fair value at the initial recognition minus plus your interest through the effective interest rate minus the coupon plus the repayment which is happening of the principal. And similarly the, if there is any impairment, you are creating any provision for it, so then the loss allowance that you will be deducting. Okay, so the principal repayment, the cumulative interest using the EIR. Yep. And the interest dividend recorded in the P&L, the gain and the loss is also recorded in the P&L. So gain losses means when you will be selling off, when you will be derecognizing this assets, so then whatever the gain and the losses are coming, so that you need to record it in the P&L. And similarly, if there is any uh, changes in the cash flow, so then when you will be calculating the revised carrying amount, so then your old carrying amount, the difference of the old carrying amount minus your new carrying amount due to the change in the cash flows, so then that will be taken as a gain or loss, and that you will be recording it under the P&L. Okay. And for the FEOC, FPTPL, so the fair value determined periodically. So here means periodically you will be determining the fair value and the difference of the fair value, that is the mark to market movement, that you will be recording in P&L for the FETPL products. And for the FEOCI, products you will be recording under the OCI reserves. Okay, and similarly here also the dividend and the interest you will be recording it under the P&L. This is what they mentioned. Similarly, the gain and the losses also for the debt instrument, and for the equity instrument, the gain and the losses it will be going under the OCI. So that is a catch here. So for the debt instrument, the interest and the dividend recorded in the P&L, and the gain and the loss is also recorded in the P&L. So same like for the amortized cost. But for the FVOC, whatever the gains and the losses are there, so that is a difference here, the key difference. So the gain and the losses, you need to record it in the OCI, because here this OCI it's not recyclable. Okay, for the equity instruments. So this is all these are the repetitive things. So but yeah, okay. So this one. Um, Okay, so just quickly, I will be going through this thing because this is also I have explained to you. Um, this is a similar, the same diagram. Okay, before starting this thing, so this also just I need to quickly, I will go through this thing for the debt instrument. So here, if you see the amortized cost, FVOCA, under the FVOCA, you're having a designated and the journal, and the FETPL designated and the journal. Okay, but in the amortized cost, there is no designation. So there's directly it is coming under the uh, yeah. So amortized cost it is not designated here. So it will be the journal only. So for the debt instrument, general means where it is going directly. Like means if the two tests of this the SPPI and the business model test are getting satisfied, so then it will be categorized under the FEOCA. But if you are taking the exception, then it will be going in the so but here you are not having any exception for the FEOCA. So so here the this designation will not come. So this is like this picture I presented in the another way. So debt instrument normally it can be classified under the amortized cost, under the FEOCA, under the general category, and then the FETPL in this are designated and the general both are there. So like here if you see, this is for the debt instrument. So here the amortized cost, FETPL and the FEOC are coming. So in the FETPL it is coming through the exception, that is through the designation, correct? So this is what I presented in this form also, this thing. So this in the FEOCA you are not having a designated here because this FEOCA designation it is coming for the equity instrument, not for the debt instrument. Yeah. So just the key takeaway is for the debt instrument, all the categories are there, the amortized cost, FEOC and the FETPL. But the designation it will be there for the FETPL only. And for the equity instrument, there is no amortized cost. FVOCI is there and the FETPL is there. So in the FETPL, there is no designation here because it's by default it will be coming as a residuary category. So that is a journal. And in the FVOCI, in the FVOCI, you will be having the designated. Um, so here this journal will not be there. So just a minute, I will be correcting it here. Yeah. So here it's journal will not be there. Only the designated will be there. Okay. So this you need to memorize all these things. Or maybe if you are conceptually clear, then there is no need to memorize it. But yeah, so this is a quick thing like means whenever the institute they are asking, you should have in your mind this picture. So just imprint it in your mind, this thing, and just think first like why this designated is coming for the equity instrument, why the amortized cost is not coming. Okay, because here they are not having the principal and the interest, so that's why this amortized cost will not be coming because the SPPA test is getting failed here. Okay, and FUSA journal it is not there here. Only the designated is there. That is also when you are test for the long-term investment of the equity instrument when you are opting for that exception. FETPL in this the designated is not there. Only the journal is there. That is a residuary category. Yeah. For the derivative, it's a by default it will be coming under the journal only FVTPL. So here I haven't taken or maybe if you want, I can do uh, this thing, but I don't want to do it here because just I'm trying to follow the institute this thing. But yeah, but here you can have the designation because when you're using the derivative for the hedging purpose, and in the hedging purpose also, if you're using it for the cash flow hedge and for the net investment hedge, then the designation can come. Okay, similarly here also the designation can come, but here it is of no use because by default it is coming under the designated in the general only. Yeah. So just remember for the derivative it is FVTPL. For the equity you FVTPL will be there, but FVOCA it can come only for the exception. And in the debt instrument it can come in all the three categories: amortized cost, FVOCI, and the FVTPL. Yep. Okay. So this quickly you can, okay, just I will go through this one. So based on the above mentioned guidance, the decision tree for the classification of the financial asset can be understood with the help of the following flowchart. So like the debt instrument, derivative instrument, the equity instrument. Okay, so like first I'm taking the derivative instrument. So the derivative instrument, uh, obviously there this SPPI is not there, so it is getting failed. So directly it is coming under the FVTPL. So this is what I have told you, that by default it will be coming under the FVTPL only, because normally the derivative you are using it for the trading purpose. Yeah. So that's why, so here this interest in the principal, it will not come, the SPPI, it will get failed. So if you see here also they mentioned the first the SPPI test is there. So this is what I was telling you, that first you need to go for the SPPI test, and then you need to apply for the business model test for the debt instrument. Okay, and this business model test, it is not applicable for the equity instrument. Okay, so now coming to the equity instrument, here if you see the equity instrument SPPA, obviously it will be failed because there you are having the contractual cash flow of the dividend, not of the interest in the principal. So SPPA will be failed. Okay, now here it is asking for the held for trading. If it is held for trading, then FVTPL. If it is not held for trading and you have taken the exception here, like the option that like the long-term investment is there, and you have you have taken the exception that is for the FVOCI. So then if you have taken the FVOCI exception, then it will be categorized under the FVOCI classified. And otherwise, if you haven't taken the exception, so then it will be coming under the FVTPL. This arrow should be opposite here, so it should be here like this. So this arrow will not be there here. Okay. Okay, so this SPPI test first. So now for the debt instrument, this SPPI test should be passed. Like if it is not passed, so then again, so it will be going under the FVTPL. Okay, and if it is passed, so then you need to go for the business model test. So in the business model test, first test is your CCF, that is the hold to collect. Correct. If the hold to collect is passed, then you need to check whether you are going for the exception, that the designation. So fair value option. So that is also the another name for the accounting mismatch, fair value option. So if you haven't opted for it, so then amortized cost will be there. So this test will be passed and this test will be passed, and you haven't taken the exception, then amortized cost will be coming for the debt instrument. Okay. Similarly, for the so this will be for the amortized cost. Now, as PPI test is passed, this one when you're coming here, and then the business model test is for to the STC to collect the contractual cash flow and the sell the asset. That is STS is there, hold to sell. Okay, if that test is passed, then are you going for the exception? If not, then FVOCA classification. If you are going for the FVOCA option, then uh, this sorry, when you are going for the accounting mismatch option, so then it will be classified under the FVTPL. Yeah, so this is the same thing the way I presented here, so which I think explained n number of times. So this is the, I find it this one more sensible, this thing. Okay, so again I'm just repeating, the equity instrument can be classified under the FVTPL and the FVOCI. Correct. FVOCI if you are taking the exception, otherwise the FVTPL will be there by default. Similarly, for the derivative also by default it will be FVTPL, unless the derivative you are using for the hedging instrument. So then for what purpose you are using the hedging. So on that basis you need to do the classification. Otherwise the derivative, this thing that derivative it is for the trading purpose. So then it will be easy. So it will be going into the FETPL. But for the debt instrument that is a complicated. So there the all the three categories are there: the FETPL, FEOCI, and the amortized cost. So this thing. So this you need to remember. Okay. So this we have covered. So now they are talking about the transaction cost. So this self-explanatory. So this is talking about the origination fee, the commitment fee, the origination fee. So this you can read it, but the takeaway is that the transaction cost for the financial asset it will be added, and for the financial liability it will be subtracted. Yep. Why? Because the financial asset. Just a minute. I will just quickly. Why this addition is there in this? Okay. I don't know why it is not coming. Okay. Okay. Just a minute. Yeah. So in the financial assets, say your fair value is say 100 and the transaction cost is say 10. Okay, so in the financial asset it will be added here. So ultimately it will be coming 110 if you are going for the amortized cost. Okay, but if it is amortized cost or FVOCI, but if it is um, your revised fair value, you can say okay. Just a minute, I will be writing it here like your fair value is 100 and your transaction cost is say 10. Okay, so now for the financial asset, for the amortized cost or FEOCI, your revised fair value is 110. But for the FETPL, it will be 100 only, because there this transaction cost directly it will be charged in the P&L, and there it is getting added. Why? Because uh, normally like uh, when you pay for the financial assets, so what entry you pass? Financial asset debit to bank, correct? 100. And similarly for the transaction cost to bank, okay, 10, 10. So both are debit, so that's why it is getting added. But if it is a financial liability, this I'm covering it here itself for the financial liability, but the later on also you will be seeing it. For the financial liability, what accounting entry you will be passing? You are receiving bank the cash, and you will be creating the financial liability. Okay, this entry and this one for the transaction cost, it will be the same entry, the transaction cost to bank. Okay, so it's 100, 100, 10, 10. So if you see here, the financial liability it is on the credit side and this transaction cost is on the debit side. So that's why if it is to be included in the amortized cost, so then it will be deducted. So it will be coming, revised carrying amount will be coming 90. Okay, so this is the thing. Okay, so ABC bank gave the loans to a customer. Okay, just quickly we will be reading the transaction cost. Otherwise, okay, the fees that are the integral part of the effective interest rates and the fees that are not the an integral part of the effective interest rate. So the fees charged for servicing the loan. So the servicing the loan, whatever the fees you are charging, so it's not relating to the origination of that particular loan. Okay, so that's why it will be taken as separate. So it will not be part of your revised fair value. A revised fair value means it will not be a part of the effective interest rate. Okay. The origination fee received by the entity relating to the creation or the acquisition of the financial assets. Such fees may include compensation for the activities such as evaluating the borrower's financial conditions, evaluating and recording the guarantees and the collateral and the other security arrangements. Okay. negotiating the terms of the instrument, and preparing and processing the document and closing the transaction. Just this is for your information purpose only, for the information. That's it. So what is happening in the, like in the loan process, you need to assess the credit quality of your customer. Okay. Then second thing, what is the customer paying any collateral or the guarantee? So that you need to see. Okay. So there also this processing fee, it will be charged for it. Similarly, the documentation, preparing the documentation also. So and negotiating the terms of the instrument also. Yeah. So these are the things which are there while you are giving the loan to the customer. So this is the whole process. So these fees are an integral part of the generating and involvement with the resulting financial instrument. Yeah. Okay. Now the commitment fee received by the entity to originate a loan where it is probable that the entity will enter into a specific lending arrangement. Okay. So these fees are, so it is talking about the commitment fee. So like you have the commitment fee received by the entity to originate a loan where it is probable that the entity will enter into a specific lending arrangement. These fees are regarded as a compensation for an ongoing involvement with the acquisition of a financial instrument. If the commitment expires without the entity making the loan, the fee is recognized as a revenue on the expiry. Okay. So it is talking about a commitment fee. Commitment fee, like the bank has given is has given the commitment that okay, during say 2 years you can take X amount of loan from the bank. Okay, so so this is the commitment. So for this commitment, the bank will be charging the fee from that particular person. That during the 2 year you can take any time the loan. Okay, so that is a commitment fee for it. So so this commitment fee, if it is, if the bank thinks that it is probable that that particular person, the particular entity to whom it has given the commitment, it will be taking the loan in during that 2 years. So then these fees are regarded as the compensation. So this is what they are describing. So what the fees is, fees are regarded as a compensation for an ongoing involvement. Ongoing involvement for the 2 years. What I have given you the example. So this thing. So example is like the bank, ICICI Bank. Okay, ICICI Bank to say um, Tata company. Okay, so it has given this commitment providing the service. So commitment is like a service. Okay, so commitment service that uh, commit service for taking the loan, for giving the loan. Sorry, for giving the loan during 2 years of say rupees 1,000 crore. So this Tata Limited can take the loan of 1,000 crore at any time during 2 years. Okay, so that commitment ICICI Bank is giving to Tata. So for this commitment service, so Tata will be giving the fees. So the ICICI Bank will be charging the fees for it. Okay. So this is the ongoing involvement. So it's not like the Tata will be taking the loan in the 2 years in a single tranche. So it can take in multiple tranches also in during the 2 years. Okay. So this is the ongoing involvement means during the 2 years the Tata can take uh, the loan up to 1,000 crore at any time. Okay, so for this one, so these fees are regarded as a compensation for an ongoing involvement with the acquisition of the financial instrument. If the commitment expires without the entity making the loan, okay, so like after the 2 years, till the 2 years means if you are standing at the end of the second year and it is seen that the Tata hasn't availed any of the loan, so then whatever the fees it has received by the ICICI Bank, it will be taking it in the P&L as an income. So if the commitment expires without the entity making the loan, the fees is recognized as revenue on the expiry. Correct? But if it is probable, then it will not recognize it as a income till the end of the 2 years. commitment fee to originate a loan when it is unlikely. So this is what it is written. This one, the same thing. The commitment fee to originate a loan when it is unlikely that a specific lending arrangement will be entered into. So if it is unlikely that okay, so Tata will not be needing the money because maybe it's because the Tata is having a bumper profit in this particular 2 years in this period. So then it will not take the loan from the bank. Just I'm giving one example. So Tata will be funding its funding requirement from its own generated profit. So if so here if it is unlikely that the Tata will be availing the loan, so uh, then also that fees you can transfer it to the P&L. Yeah, so the fees that are not an integral part of the effective interest rate. Okay, so this is a commitment fee. Now coming to the origination fee. Origination fee paid on issuing the financial asset measured at the amortized cost. These fees are an integral part of generating an involvement with the financial liability. An entity distinguishes the fees and the costs that are an integral part of the effective interest rate for the financial liability from the origination fee and the transaction costs relating to the right to provide the services such as investment management services. Okay, so this is another type of this one where the origination fee it will be there. Uh, these fees are an integral part of generating an involvement with the financial liability. Okay, so these are the three different type of the fees are there. Okay, so and here the loan syndication fee received by an entity that arranges a loan and retains no part of the loan package for itself or retain a part of the same effective interest rate for comparable risk as the other participant. So the loan syndication fee is like the ICICI Bank has given the loan to Tata, okay, of 1,000 crore, and then ICICI Bank it is selling that it is syndicating with the other banks. Okay, so like it is approach going to the other bank SDFC. Okay, will you be participating in this one in 1,000 crore, which will be given to the Tata. So this is called as a loan syndication fee. So for this one, if the SDFC say will be saying yes, if it is says yes, so then ICICI Bank will be charging some fees because ICICI Bank has taken the pain to enter into an agreement with Tata. Okay, so just for reaping that benefit by the SDFC Bank, so ICICI Bank will be charging the fee for this one. So this is a loan syndication fee. So this will not be an integral part of the effective interest rate. So this is like okay, but yeah, but ultimately the takeaway is that the transaction cost it will be added in the financial asset for the amortized cost. Okay. Um, and for the FVOCA also that will be added, and for the fair FVTPL products it will not be added. It will be directly charged to the P&L. Okay, and for the financial liability for the amortized cost it will be deducted. So the reason I have given why it is deducted because one is created here the financial liability and the transaction cost is debited. So that's why both are in the opposite this thing. So that's why it will be deducted. But here in the financial asset, both are in the same direction, like the debit, so it will be getting added. Okay, so ABC, so coming to the example, so ABC Bank gave loan to a customer, the Target Limited, that carries a fixed interest rate of 10% per annum for 5 years and 12% per annum for the 3 years. Additionally, the bank charges processing fee of 1% of the principal amount borrowed. The Target Limited borrowed the loan as follows: the 10 lakh for the 5 year terms and the 8 lakh for the term of the 3 years. Compute the fair value upon the initial recognition of the loan in the books of the Target Limited and how the loan processing will be accounted for. So it's very straightforward. So like So here it's a fixed rate loan. So here the CCF, so it will be amortized cost, because if you see nothing has told about like means whether it will be selling it or not. So we are presuming that it will be, the bank will be holding it till the maturity. Okay. So that means the amortized cost will be followed here. Now in the amortized cost, so here having the two type of this thing, the loan. So 10 lakh uh, for the 5 year. Okay, you're having an interest of 10%, and for the 3 years, you're having an interest of 12%. So if you see your this interest rate curve, it is the upward moving. So upward moving, like if this is the interest rate on this axis, in the y-axis interest rate, okay, and here if it's a time period. So with the time period, so if it is of the larger horizon, so then your sorry, it's not the upward movement, so it is the downward movement, you can say. Like if the maturity is increasing, so then your interest rate is coming down. So this is a downward movement, downward interest rate curve, you can say, the yield curve. Okay, so for the 3 years, you are charging the higher interest, 12%, and for the longer period, you are charging the less interest. So that is a downward yield curve movement. This is there. So for the 5 year, you are having a 10 lakh amount. Okay, and for the 3 year, you are having 8 lakh amount. So it's a financial asset. So that means the 10 lakh plus. So I think this is, yeah. So it is talking from the target limited point of view. That is from the customer point of view. So that is for the target limit. It will be financial liability. So for the financial liability, you need to deduct it. So 0.1% of 10 lakh, you will be deducting it. So then whatever the revised value will be coming, it will be coming 9 lakh 90,000, 9.9 lakh. Okay. Similarly for the 3 year, it will be 8 lakh minus 0.1%, not the 0.1%, it is 1%. Yeah, it's a 1%. My apologies, 1%. So 1% of 8 lakh. So it will be coming, you will be deducting it here. So it will be coming 7.7 lakh 92,000. So this is what it is written here. So the loan from the ABC. So see, here you are discussing about the financial asset, but then you are giving an example of the financial liability here. So that is like you can say the irony here. It should come below, not in the financial asset. Yeah, but nevertheless, the loan from the ABC Limited carry the interest at the 10%, the 12% for the 5 year term and the 3 year term. So that means a downward yield curve. Okay. Additionally, there is a processing fee payable at the 1% on the principal amount of the date of the transaction. It is assumed that the ABC bank charges all the customers. So just this for the information purpose. Normally, like to have the harmony with all the customers. So you miss the bank is not discriminating with any of the customer. So charges all the customer in a similar manner, and hence this is a representative of the market rate of interest. Amortized cost is computed by discounting all the future cash flow at the market rate of interest. Further, any transaction fee that are an integral part of the transaction are adjusted in the effective interest rate and recognized over the term of the instrument. So hence the loan processing fee shall be reduced from the principal amount to arrive the value of the day one upon initial recognition. So fair value, this is what I have told you, this one. So 10 lakh minus 10,000, it is coming 9 lakh 90,000, and similarly for the 3 year, 8 lakh minus 8,000, 7 lakh 92,000. So now the effective interest rate, of course, if this your revised value is 9 lakh 90,000, and then whatever the future cash flow it will be there. So future cash flow, like for this 5 year, it is 10%, no? So 10% of 1 lakh. So that is 1 lakh, 1 lakh, 1 lakh. Yeah. So this 1 lakh plus 10 lakh. So when you will be discounting it, so it will be coming, had been, instead of 9 lakh 10,000, if here the 10 lakh is there, so that means you are issuing at par. So here the discounting rate will be your 10%. So that is the 10% will be there. But now if you are reducing from 10 lakh to 9 lakh 90,000. So then the discounting rate should be higher than 10%. Okay. So this is what they have mentioned here. So now the effective rate shall be higher than the interest rate of 10% and the 12% respectively, so that the processing fee gets recognized as an interest over the respective term of the loan. So just again, I am telling you, just requesting to you to see the to have a look into that video of the effective interest rate. Then it will be easy for you to see all these things, because it's just like your mathematical thing. Or otherwise, you will be learning all this thing in the AFM also, playing with the time value of money. Okay, fair value. So now they are say telling you just in a quick this thing. So this we will be covering in the Ind AS 13, Ind AS 113 in detail. But yeah, so this is a quick snapshot of the fair value what it is. So it is taken from the Ind AS 113. So fair value is the price that would be received. So here this is a definition. So fair value is the price that would be received to sell an asset. Okay, like if you are having an asset, then the price at which you are exiting that asset means exit price. So exit price will be your fair value, not the entry price. Entry price means the price at which you are buying that asset. So it is not that thing. So it is like when you are selling an asset, and whatever the price at which you are exiting, the price at which you are selling it. So that is the price you need to consider. Okay, so this is the definition of the fair value, or paid to transfer a liability. And for the liability, like for the de-recognizing it, you need to pay the cash, correct? So the price which you are the cash which you are paying for removing the liability from your balance sheet. So that price will be your fair value for the liability. Paid to transfer a liability in an orderly transaction. Orderly transaction means it should be like your the arm's length price. So all these things you will be learning in India's 13. So this is a very important definition, you can say. Um, just a minute, I'm removing. Okay. So in an orderly transaction between the market participants. So this is talking about at the measurement date. So the price at which you will be exiting the asset. So that is your exit price, and the price at which you are the cash which you are paying for removing the liability. Okay. In an orderly transaction means the arm's length, where you are not having this the relative factor is not coming. Okay, between the market participants at the measurement date. So this you will be means we will be covering in detail when we will be seeing the Ind AS 113. Okay, so this is the catch here. For selling an asset, you need to see the exit price, not the entry price. So that is the main catch point here. So per Ind AS 113, the objective of the fair value measurement is to estimate the price at which an orderly transaction to sell the asset or to transfer the liability would take place between the market participants at the measurement date under the current market conditions. A fair value measurement requires an entity to determine all of the following: the particular asset or the liability that is subject of the measurement consistently with the particular asset. Means that asset should be identified. Okay, for a non-financial asset, the valuation premise that is appropriate for the measurement. Okay, consistently with its highest and the best use. So this is for the non-financial asset, and the principal amount, the principal market. So this orderly transaction between the market participant, it should happen in the active market, the most advantageous market. Okay, that is the principal market for the asset or liability. From there, you should determine the price. Okay. The valuation technique appropriate for the measurement, considering the availability of the data with which to develop the input that represent the assumptions that market participant would use when pricing the asset or the liability, and the level of the fair value hierarchy with which the inputs are categorized. So here this leveling. So level here in the Ind AS 113, here you are having three levels. Level 1, level 2 and level 3. So in the level 1, you can simply say that that particular asset is tradable in the market. So like your Reliance shares, so it is tradable in the stock market. So then from there you will be taking the price. Okay. But in the level 2, like any company which is not listed on the stock market, okay, so that is means it is not tradable. So then you will be going for the similar transactions here, like the that company, the similar to that company which is listed in the market. So then you will be taking that first you will be identified as the similar entity which is listed, and then you will be taking that price, okay, and doing some adjustment. And the third level, like uh, means you are not able to find out, means here you are having your own technique, means you are using the model to derive the price of it, because it is not tradable in the market. So these three levels are there. This one is the most preferable, okay. This one, so because this is the most transparent, because here you can see the price in the market, okay. But in the level 2, in the level 3, that is a worse, like means here you cannot see the price. So here you are just simply relying on the model, okay. So the model on which basis you are determining the price here. These three levels are there, okay. So now if we go on to understand the key aspect of the initial and the subsequent measurement, along with how the classification of the assets affect their measurement, as explained in detail below. Okay. So now it is talking about the initial measurement. So the initial measurement, the fair value, so just again the repetitive. So but yeah, here the off market is coming. So this will be seen here. So this will be coming in this one. So that's why I've explained little bit about providing you the limited information about the leveling here. So the fair value of the financial instrument at the initial recognition is normally the transaction price. Okay. Transaction price means the price at which that transaction has happened, the cash which you have paid. Normally that is equal to your fair value of the consideration given or received. So instrument at the off market terms. Off market terms here means where you are having your the fair value is different from the transaction price. So that is your off market terms. The best example is your employee. Like the bank is giving the loan to its employee at a cheaper rate. Okay, lower than the market interest. So that is called as off market terms. So sometimes certain types, so here it will be coming three types of the instrument. The parent is giving loan to the holding company. Sorry, parent is giving the loan to the subsidiary company. Then second one is the lease contract. In the lease contract, you are having that the security deposit. This also we have already covered earlier. So the security deposit where it's interest free. Okay, and the third one is your the company is giving the loan to its employee. Okay. Okay, so sometimes certain types of instrument may be exchanged at off the market terms. That is different from the market terms for a similar instrument if exchanged between the market participants. For example, a long-term loan or the receivable that carries no interest, while similar instrument if exchanged between the market participants carry the interest. Then the fair value for such loan receivable will be lower from its transaction price owing to the loss of the interest that the holder bears. Okay. In such cases where the part of the consideration given or received is for something other than the financial instruments. An entity shall measure the fair value of the instrument. Yeah. So this is like you can take the example of the lease. So in the lease, the security deposit. Okay. So uh, the security deposit which is the interest free. So so that example is fitting into this what it is trying to say. Okay, so in the aforementioned example, the fair value of the long-term loan or the receivable can be measured as the present value of all the future cash received. Okay, so this is what they're telling you, the how the fair value will be determined. You will be discounting it at the market interest rate of that principal amount if it is an interest-free loan. Okay, so the fair value of the long-term loan or the receivable can be measured as the present value of all the future receipt discounted using the prevailing market interest rates for the similar instrument, similar to a currency. So the currency should be also same. the type of interest, the term should be same, and the other factor should be same here with a similar credit rating. The additional amount lent is an expense or reduction of the income unless it qualifies for the recognition as some other type of the asset here. Okay, so like if suppose if I'm taking one example, so uh, in the lease, okay, or you can say not in the lease, you can take the example for the employee also. So the company has given a loan. Okay, so just I'm writing here in the short form, the company has given a loan of say 10 lakh to its employee, say Rajiv. Okay, to its employee. Okay, at 4% per annum for 5 years. Okay, and this Rajiv will be returning that amount in the form of the interest plus the principal. Yeah, so principal here it's a bullet payment just for the simplicity. Okay, so the market interest rate it is currently it is going say 7% here. Okay, so 4%. So that means 4%. How much would be it becoming? I think 40,000 if I'm not wrong. 10 lakh into 4%. Yeah, 40,000. Okay, so that means the 40,000. The best way like means this is the way means it's my style. So 40,000, 40,000. Just write the equation here directly. So it will be easy for you also. 40,000. Okay, and at the end 40,000. Just writing in the short and plus 10 lakh. Space crunch. Okay, so here it is a 10 lakh 40. So 1 plus x, 1 plus x square, because you will be getting this after the 2 years, and this you will be getting after the 3 years, this interest. 1 plus x, that is a 4, and this will be 10 lakh plus 40,000 you will be getting at the end of the fifth year. Okay, so this and the life of the loan is 5 year. So 1 plus x raised to the power 5. Okay, so now this x I have already given you 7%, so that means it will be coming 0.07. Okay, so 1 plus 0.07, so 40,000 divided by 1.07, so on, and at the end of the fifth year, it will be 40,000 plus 10 lakh, it will be 1.07 raised to the power 5. So whatever the value you will be getting, so say if you are getting, say, just hypothetically, you are getting say 6 lakh. Okay, assume figure 6 lakh. So what accounting entry you will be passing here from the bank's perspective? So bank has given a loan of 10 lakh. Okay, and it will be recording the asset, the financial asset of 6 lakh, and then the difference you can say uh, like whatever you want, like it is for the service. Okay, so like they have put the condition that okay for the till the fifth year, and you need to be an employee of this company to have this 4% perk, means the 4% facility. Okay, so this for service, the 4 lakh. Okay. Now, if this loan, if it is not tradable, normally it is not tradable in the market, so it will be coming under the level 2 or level 3. Okay, normally it is coming under the level 3. So if it is coming to the level 3, so that means this now 4 lakh you need to write off as and when the employee will be completing the 1 year of service. So 1 lakh, not means you need to write off it is in the 5 year in the P&L. So this is what they're trying to say. Okay. So the fair value of the long-term loan or receivable can be measured at the present value of all the future cash received discounted uses the prevailing market rate of interest for a similar instrument. Okay, the additional amount lent is an expense. Okay, had it been the level one asset, okay, had it been trading in the market, so then you will be charging this 4 lakh at the inception itself as a loss in the P&L. Okay, so the additional amount lent is an expense or a reduction of the income unless it qualifies for the recognition as some other type of the assets. Okay, so the transaction cost includes, so this again it will be coming in the picture form. Okay, so again just we will be revising it there also. Just bear with me. So the transaction cost. So the transaction cost include the fees and the commission paid to the agents. So this is what they're telling about what is the definition of the transaction cost here. The transaction costs do not include the debt premium, of course, and the financing cost or the internal administration or the holding cost. Yeah, just for the knowledge purpose. Any transaction cost incurred for the acquisition of the financial asset or issue of the financial liability are adjusted upon the initial recognition while determining the fair value. If the financial asset or the financial liability is not classified as subsequently measured at the FVTPL. Yeah, for the FVTPL, it will be charged under the P&L, the transaction cost. If an entity originates means what I told you earlier, that originates means if it is giving the loan, it is not buying the loan from the market, it is giving the loan to the customer. So if an entity originates a loan that bears an off-market interest rate, example the 5% when the market rate for the similar loan is 8%, and receives an upfront fee as a compensation, then the entity recognizes the loan at its fair value, that is net of the fee it receives. Okay, like if it is giving at a cheaper rate, but yeah, the customer is also giving you an upfront fee for it, like you're giving it for to me at a cheaper rate. So the fees also you're charging, so that fees will be getting adjusted from the fair value here. The decision tree for the aforementioned basis to be applied. Okay, so now it is giving you the decision means in the picture form. Okay, so again the same thing what I have explained you. So it will make your base more strong. So initial measurement instrument at the market terms. So then the transaction price. Why at the transaction price? Because the fair value is equal to your transaction price because it is entered at the market terms. Okay. Instrument at off the market terms. So then determine the fair value of the financial instrument through the present value method. That is the discounting. Okay. Now if the fair value based on the level one input. Okay. Level one input or the valuation technique that uses only the data from the observable market. That is a level, I think that is the level 2 observable market. So just simply take as a level 1 only. So then the difference between the fair value and the transaction price recognized in the PLL. So if your the asset is tradable in the market, so then from there you can take the price, okay, because that price is a transparent price. So then whatever the difference is there between the fair value and your transaction price, directly recognize it under the PNL. Otherwise, any other base. So here the evaluation technique that uses only the data from the observable market. So I think here the level 2 is also covered here, but maybe let's this let's park it until we cover the IFA, Ind AS 113. So there it will be having more clarity whether here this level 2 is also there or not. Because if you are using the input from the observable market, so then and then you are computing the price, so then also it is covered under this one. Okay, and otherwise any other basis like the level 3 where you're using a modeling approach to determine the price, so then difference between the fair value and the transaction price recognized as an asset or otherwise amortized to the P&L. Okay, so the specific transaction now. Okay. The specific transaction determining the amortized cost for the financial asset carrying the floating rate of interest. So this is again, this is for the knowledge purpose. Uh, it is saying the floating rate. So because in the floating rate also, uh, that you will be determining the interest rate at a regular interval. Okay, so here the interest rate is not fixed. Uh, shall I give you one example here? Just a minute. So, like if you have given a loan for 1 year, okay, and you're paying the interest on the quarterly basis. So, 4 quarters will be there. Okay, and here, like when you are standing here, so then the interest, whatever you will be paying at the end of the first quarter, so their interest rate will be determined here. Okay, similarly, when you will be reaching here, then when you will be reaching here, so then again you will be determining the interest rate for the next quarter. Next quarter you will be determining. Okay, so you will be determining the interest rate for the this quarter here itself. Okay, similarly, uh, so if you see here, the every in every quarter your interest rate is getting changed here. So this is what um, is the process of the floating rate. Okay, so here the interest rate is not fixed. So at the end of the every quarter, your interest rate is getting changed here. So this is the process of the floating interest rate. Yeah, I think this also you will be covering in the AFM. Yeah. Okay, so for the floating rate, you can just read it. So just it's a theory, but yeah. So but again, this floating rate interest, because ultimately you are coming again here at the market rate. Okay, at the every quarter end, you will be coming at the market interest rate for the floating interest rate. So just simply, I'm just reading it quickly. So as per the application guidance in the Appendix B for the floating rate financial instrument, the periodic re-estimation of the cash flow to reflect the movement in the market rate of the interest alters the effective interest rate. Yeah, alters the effective interest rate. Because why? Because this like suppose when you're standing here, your interest rate is say 3%. Okay, so this 3% it is for your 1 quarter only. Okay, so 1 quarter, one when you will be reaching here, then again whatever the interest will be there in the market for the next quarter, so it will be say 4%. So then that interest rate you need to take. Similarly, when you are reaching to the second quarter end here, so then you need to take the interest rate which is there in the market for the next quarter in the future. So suppose if it is coming say 3.5, so that you need to take. So that's why it is keep on changing. Okay, so that's why your effective interest rate is keep on changing here. But for this quarter, this is the fixed interest rate you can say. Okay, but for the whole year, your interest rate is changing on the basis of the market interest rate. So that's why it is called as a floating interest rate. But for this quarter, this is the fixed interest rate. Similarly, for this quarter, this 4% is the interest rate. And similarly, for this quarter, this is the fixed interest rate. Okay. So to calculate the effective interest rate in each relevant period, the effective interest rate is applied to the amortized cost of the asset or the liability at the previous reporting date. So the previous reporting date means for this one, for this quarter, this is your previous reporting date. So this will be your interest rate for this quarter, yeah, which you have determined in the beginning. So that's why it is mentioned the previous year. However, if the floating rate financial asset or the financial liability is initially recognized at an amount equal to the principal receivable or the payable on the maturity, that is at par, then the periodic re-estimation does not have a significant effect on the carrying amount. Like here, this is miss. I'm going little bit in detail, but just at a high level. Just don't ask me what is the logic, because for the logic, if I need to explain, if I explain you, so then it will be taking one more up. But I think it's not of use. Okay, so like 3%, if you are saying like means whenever you are resetting, so this is called your resetting here. So whenever you are every time at every quarter when you are resetting your interest rate, so then your fair value it becomes par at par. Why? Because whatever the interest coupon you are taking. So here it's a 4%. So then the same interest you are using for the discounting purpose also. So when your numerator, that is for the coupon, and for the denominator, that is for the discounting, if the both the rates are same, so then obviously your fair value will be your par value. So this is what they are trying to say. Okay. So therefore, in such cases, for the practical reason, the carrying amount of the floating rate instrument would not generally need to be adjusted at each repricing date because it will be at par only. When your coupon rate and your discounting rate both are same, because the impact would not be generally be significant. So interest income or expense is recognized based on the current market rate. Okay. And for a floating rate financial asset or the financial liability that is initially recognized at a discount or premium, the interest income or the expense is recognized based on the current market rate plus or minus the amortization or the accretion of the discount. Yep, perfect. So in the special transaction, it is taking the small thing, the floating rate, then if there is a revision of the estimated cash flow, okay, so like the prepayment option, all those stuff. So like here it is said, revision of the estimated cash flow. As per the guidance in the Appendix B to the Ind AS 109, if there is a change in the timing or the amount of the estimated future cash flow other than due to the impairment, okay, other than due to the impairment, just keep this in mind. It shall adjust the gross carrying amount. This is very important. You should understand about it. This gross carrying amount of the financial asset or the amortized cost of the financial liability or the amortized cost of the financial liability to reflect the actual or the revised estimated cash flow. Okay. The entity recalculates the gross carrying amount of the financial asset or the amortized cost of the financial asset as the present value of the estimated future contractual cash flow data discounted at the financial instrument original effective interest rate. Okay. Or the credit adjusted effective interest rate or purchased or the originated credit impaired financial assets. So this we call it as a POKI, POKI. So like if you are buying any impaired loan from the market, it is not originated, means you are buying it from the market, and which is the credit impaired, means where the credit event has happened. So that is called as a credit impaired. Okay, this also I have explained to you. So thus the carrying amount of the instrument is adjusted in the period of the change, okay, with the corresponding gain or loss in the P&L account. So this approach to change in the estimated cash flow should apply to the changing prepayment expectation, okay, like where the prepayment option is there, and the other estimate of the cash flow under the current term of the financial, but not to a renegotiation of the contractual term, because for the for the renegotiation you will be having a different chapter here for the renegotiation. So okay, so just I'm taking one simple example here because this is little bit tricky also. uh, I don't know how much you will appreciate, but yeah, just try to understand this example. Uh, just a minute. How to say? Uh, mm, amortized cost it is talking about. Okay. So like there is an instrument, bank has given a loan to XYZ Limited. Okay, of rupees say 2 lakh for 3 years at the market interest rate. So at the market interest rate, okay, at the market interest rate, say at 10%. So then, okay, so just I'm preparing the number line here also. One, two, three. Okay. So 10% means your 20,000 each year you will be getting plus So this is example of the bullet payment, bullet repayment. So this you will be discounting it here. This will be discounting it here. So here your coupon rate, coupon and the market, the discount rate both are same. So that means here the fair value will be your uh, 2 lakh only. Okay. Why? Because in the numerator, so 2 lakh into 10%, what you are doing, divided by 1 plus your discount rate, that is also 10%. Okay. So plus 2 lakh, so this is coming here 20,000. So 20,000 in the next year, 1 plus zero point 0.1. So this is your 10%. Okay. Plus 2 lakh 20,000. This is a 1 plus zero point 0.13. So here if you see this in the numerator, this is a numerator I'm talking about. This is a numerator. So here your coupon rate is 10% and here your discounting rate is also 10%. So if both are same, so obviously your fair value will be your par amount. That is a 2 lakh it will be coming. So this you can cross check also yourself. But if your coupon rate and the discount rate are different here, so then the fair value will not be the par amount. Okay. Now, so this is your par. So now 1 month, 1 year is over. So now if the entity is expecting that instead of 20,000, some like means there is a downgrade of not the downgrade. So maybe uh, like it is expecting that uh, like the interest rate has gone down. So now it is expecting that the XYZ will be prepaying the loan. Okay, so now if you are standing here, so now only the 2 years are left. So here itself, the company will be uh, here the company will be paying the outstanding amount. So directly itself. So nothing in this one, so nil amount here. So it will be prepaying the outstanding principal here itself at the end of the second year. Okay, now you are standing here. So now this 20,000 plus 2 lakh, you will be discounting it. Okay, uh, at the this. Okay, so I was saying that instead of this, maybe mm, like instead of 2 lakh here, like they are prepaying some um, some principal amount here, say 40,000. Okay, and the remaining 1,60,000 here. Okay, so and this situation has come because their financial position means there is a bumper profit in their company, so that's why they are paying the in prepaying the interest. So because of this revised cash flow, when you will be uh, doing it, okay, if say something it is coming like just hypothetically, I'm taking 1,80,000. Okay, so then whatever the difference it is there, because here also this amount, this one, so here also it will be 2 lakhs. So so whatever the difference will be there. So this is like your gross carrying amount. So gross carrying amount means what? Your fair value. So fair value it is here 2 lakh plus the coupon interest rate 20,000 and sorry, the EIR, the interest which is calculated from the EIR and then the coupon. Okay, so this is a thing. So still means it is coming 2 lakh. Okay. Uh, so then whatever the difference it is there because of the revised cash flow, if it is coming 1,80,000, so then here 20,000 you will be taking it in the PNL. You are booking it as a loss because it's the value it is getting reduced because you will be recovering less interest amount here. So that's why. Okay, so this is what they're trying to say. Okay, so interest income after the impairment recognition. So this also after the impairment recognition, if a financial asset or the group of the similar financial asset has been written down as a result of an impairment loss, then the interest income is thereafter recognized using the rate of interest used to discount the future cash flow for the purpose of measuring the impairment loss. And here also this effective interest rate will not get revised, so it will remain same as it is even after the impairment also. Okay. And then the impairment. So here the interest income is thereafter recognized using the rate of interest used to discount the future cash flow for the purpose of measuring the impairment loss. Okay, for measuring at the amortized cost and this interest rate. So here so the interest rate, the EIR will not get revised. It will remain same as it is. Okay. So now coming to the next point of the specialized transactions here, the loans between the group of companies. So this I was just referring to you in the beginning. Okay. So here the various type of things are there. So like the repayable on demand. So if the repayable on demand, so then the fair value it should remain equal to your at least to your what it is there in the repayable on demand. So that amount should be there. So the fair value of the financial liability with the demand feature, example, a demand deposit is not less than the amount payable on the demand. Okay, discounted from the first date that the entity could be required to repay the amount accordingly. Okay, the the fair value of an interest-free loan liability of which the lender can demand the repayment of the face value at any time, that is the loan repayable on demand, is not less than its face value. Yeah, so means whatever the amount the holder can ask to repay, so that at least that amount should be there as your fair value. So this is what they're trying to say. So this would even evenly apply from the perspective of the lender, since a market participant acting in its best interest would be assumed to maximize the value by demanding the immediate repayment, and hence the fair value shall be equal to the amount payable on demand in the books of the lender. So for the lender also it will be the same. Yeah. So for the lender and for the issuer, for the lender and the borrower, so the amount should be at least what the lender can ask to repay. So at least that amount should be the fair value at least. Okay, so no fixed maturity. If the no fixed maturity is there, so then you need to uh, anticipate, like means till what time this amount can be repaid. So if a loan has no fixed maturity date and is available in perpetuity, then in measuring its fair value, discounting should reflect these terms, because a market participant acting in its best interest would not assume the repayment of the loan. Yep. Similarly, the asset holder or the lender would also measure the fair value that should reflect a market participant's assumption about the timing. So there, so whatever the market participant they will be assuming, so that assumptions you need to apply. So in how much time this repayment will be happening. So this you need to anticipate from the lens of market participant. Okay. So in both the above cases, any differences which arises. So here whatever the differences arises, because here the parent, I think this example is the parent is giving the loan, no? The loan between the group companies. So here it will be like the for the lender it will be the equity investment, and for the borrower it will be like your equity. So any difference between the amount lent and the fair value of the instrument on the initial recognition is recognized as a gain or loss unless it qualifies for the recognition as an asset or the liability. Okay. If a low interest loan is given in anticipation of the right to receive the goods, so so here it is talking about if any other transaction is also there. So if low interest in anticipation of right to receive the goods, so then whatever the difference will be there, so that will be taken as a right, like means the amount for the right to receive the goods and the services at the favorable services at the favorable price. So then right may be recognized as an amount if it is qualify for the recognition as an asset, for example, the prepaid expenses. Yep. Okay. So the demand deposit, the fair value of the financial liability with a demand feature, example, a demand deposit is not less than the amount payable on demand, the discounted from the first date. Okay, hence the fair value of the demand deposit would be the amount payable on demand in the books of the party making the deposit, as well as in the books of the entity anticipating the deposit. So this is the same thing. Okay, so now this is a example like from the container point of view. So let's see. So container limited provides the containers for use by the customer for the multiple purpose. The container are returnable at the end of the service contract period 3 years between the container limited and its customer. In addition to the monthly charge, there is a security deposit that each customer makes with the container limited of rupees 10,000 per container, and such deposit is refundable when the service contract terminates. So deposits do not carry any interest. So this is interest-free loan. So analyze the fair value upon the recognition in the books of the customer leasing. So this is the same like for the lease under the leasing contract. So this is there like the container means you are given the security deposit for the container, and you will be getting this money back uh, without any interest. So this is interest-free loan. So whatever the amount it is there, 10,000. So this you will be discounting at the market interest rate, and this is for the 3 years. So this is whatever the amount it is getting PV. So this is the transaction price you can say. So sorry, the fair value. So then 10,000 minus your this whatever the amount it is coming fair value. So that difference you will be recognizing it as a uh, as what as a refundable amount in the asset. Yep. So in the above case, the customer leasing the container makes the interest-free deposit which are refundable at the end of the 3 years. Now this money, if it was lent to the third party, would fetch 7%. So hence discounting all the future cash flow, that is 10,000. Okay. So fair value on the initial recognition 10,000 divided by this one. So this is coming 8163. So now the difference is 1837. So now if the fair valuation is determined using the level 1, if it is using the level 1 input, uh, hmm, level 1 input, I don't know why it is not coming. Just a minute. Yeah. So level 1 input. So that means, so the difference, this 1837, it will be transferred to the P&L. If it is not level 1 input, then it is determined using the other input. So difference, so it will be recognized in the P&L, or unless if it meets the definition of the asset or liability. So in the case of the security deposit, level 1 in fair value is not available. So therefore, the above case, the fair value is made based on the unobservable inputs, and hence the applying the scenario 2, this one can be recognized as an asset like the prepaid rent, you can say, if it meets the definition. Now since the lessee gets to use the container in return for making the interest free deposit plus the monthly charge, the lost interest representing the day one difference between the value of the deposit and its fair value, the prepayment lease rent. So prepaid lease rent and can be recognized as the prepaid rent, that is a right of use of asset shall be charged to the P&L in a straight line basis. So, what will be the accounting entry here in the books of the lessee? That is in the books of the customer. So it will be to bank account 10K Okay, the security deposit receivable, security deposit receivable. Okay, receivable. Just I'm writing the short form here, receivable. So it will be 8163, and the difference it is 1837. It's a raw asset, right of use of asset, or it's you can call it as a prepaid rent, and this you will be amortizing in 3 years on the basis of the SLM. Yep. So here you are recognizing it as an asset here. Okay. So this is done. Now coming to the subsequent recognition. So this is also straightforward. So I think it will be easy because we have made the foundation. Uh, so as defined in the flow chart above, the subsequent measurement of the financial asset is based on their classification as defined below. Assets measured at the amortized cost. Assets are classified as measured at the amortized cost if the below conditions are met. So that is the business model CCF, that is your hold to collect, and the SPPI test. Okay, when the assets are classified at the amortized cost, so they are not telling the definition of the amortized cost. What is the meaning of the amortized cost? So fair value plus your this one EIR interest plus minus your coupon and then the repayment and then your loss allowance. So that will be your uh, amortized cost. So for assets not carried at, okay, so now it is coming the, I think the later on they will be telling you the meaning of the amortized cost also. Yeah. So now it is coming to the fair value. So for asset not carried at the amortized cost, they shall be carried at the fair value. So fair value, so here the FVOC and the FVTPL both are coming. So such asset can be categorized into FVOCs. So now they are telling one by one. One is for the FVOCA, then the another one it will be for the FVTPL. Okay. So measured at the FVOCA. So here also it is telling the definition like means the test. So one the business model where you are having a CCF M plus HFS, the held for sale, that condition for the business model and the SPPI test. Yep. Or an equity instrument which is for the long term, so then you can designate it irrevocably. Okay, in the under FVOCA. And FVTPL is your remaining category or the designated one. So all the assets not classified as a measured at the amortized cost or the measured at the fair value through OCA shall be classified in this category. So that is the residuary one. And then this is the income or expense, again the repetitive one. So income or expense it will be charged under the P&L. Okay, and the mark to market movement under the FVTPL it will be charged, it will be transferred in the P&L. And similarly, the mark-to-market movement of this FVOCA of the equity instrument, it will be going under the OCI. So interest dividend recognized in the profit or loss, gains and losses under the FVTPL, it will be going under the P&L. Okay, recognizing the P&Ls, realized and the unrealized both. And the FVOCA other than the equity instrument, so then the realized one, it will be going in the P&L. And for the unrealized it will be going in the OCI, and for the equity both the unrealized and the realized it will be going under the OCI. Yep. Okay. If the financial instrument was previously recognized as a financial asset is measured at the fair value through P&L and its fair value decreases below zero, then it is a financial liability. So I think this is uh, self-explanatory. Yeah. So if the fair value is going zero, so below zero, then it will be coming as a financial liability, and vice versa. Equity instrument where the fair value not determinable. So now it is saying that if the equity instrument can be measured at the cost also, at cost. Yep. At cost. So where the fair value not determinable, so then all the investment in the equity instruments and the contracts on those instruments must be measured at the fair value. However, in limited circumstances, cost may be an appropriate estimate of the fair value. Cost. Yep. Cost. This that may be the case if the insufficient more recent information is available to measure the fair value, or if there is a wide range of the possible fair value measurement and the cost represent the best estimate. Yeah. And this is like theoretical one, so indicated that the cost might not be a good representative where there is a lot of uh, changes happen in the company or in the market relating to the company. Yeah. So significant change in the performance of the investee, change in the expectation that the investee's technical product milestone will be achieved, or significant change in the market of for the investee's equity, significant change in the global economy which is impacting the investee, significant change in the performance of the comparable entities, okay, internal matters, then the evidence from the external transactions. The list above is not exhaustive. An entity shall use all the information about the performance and the operations of the investee that becomes available after the date of the initial recognition. To the extent that any such relevant factors exist there, this might indicate that the cost might not be the representative of the fair value. In such case, the entity must measure the fair value. So, okay, so cost is never the best estimate is never the best estimate of the fair value for the investment in the quoted investment securities. If it is a quoted, so then you will be taking the quoted price. So that will be a fair value. Okay, sorry. Now coming to the question here. So accounting for the transaction cost on the initial and the subsequent recognition of a financial asset measured at the fair value with the changes to the OCI. Fair value through the OCI. Okay, fair value through the OCI. Okay, so an entity acquires a financial asset for CU 100 plus a purchase commission of 2. Okay, an entity acquires, so this is talking about the FEOCA. Okay, in the FEOCA, how the what transaction cost you will be taking it. So an entity acquires a financial asset for CU 100 plus the purchase commission of 2. Initially, the entity recognizes the asset at 102. Yeah, so 100 plus 2. That is for the financial asset. So it will get added. So that's why it is coming. The revised fair value will be 102. The reporting period ends 1 day later when the quoted market price of the asset is 100. Okay, so now, okay, if the assets were sold, a commission of 3 would be paid. How would the transaction cost be accounted for in the books of the entity? Okay, so first thing, at the purchase date, that is at the initial recognition, your uh, fair value plus commission will be your revised fair value. Okay, so that means 100 plus 2, 102 it will be. So the entry will be uh, financial asset 100, okay, to bank 100, first entry. Then second entry will be your commission to bank 2, currency 2, CU means currency, okay. And then third will be financial asset to commission 2. So ultimately it will be coming 100 here it is debited for the financial asset and 2 it is debited in under the financial asset. So then so financial asset will be recorded at 102 in the balance sheet. Now at the next day your the quoted price is 100. Okay. So quoted price if the asset was sold a commission of 3 would be paid. So this will be ignored. So like so in the exit price, like in the fair value definition, what I mentioned you that you need to consider the exit price, correct? So for the exit price, whatever like while exiting, whatever the expenses you are bearing, so that you don't need to consider it. So that's why you need to ignore this thing. So only the 100 you need to consider. So now the value it has gone down from 102 to 100 next day. So then what you will be doing to OCI because it's a you have recognized it under the FVOCA. So that means whatever the mark to market fluctuation is there, so that you will be transferring it to the OCA. So to financial asset 2. This will be on the next day. Next day. So then your financial asset will be shown at 100. At 100. From 102, so this is debited. So that means you are showing it at 102. Now you are creating the financial asset by 2, so that means the financial asset will be at 100. So this is the solution. So now see, so little bit, yeah, little bit confusion is there, but yeah, this I will explain you. On that date, on that date means it is talking about the next day. The entity measures the asset at 100 without regard to the possible commission on sale and recognizes a loss of 2 in the other comprehensive income. Okay, so this is what I've told you. So this is on that date means it is talking about this one, next day. Okay, now it is coming on the first day here. So if the financial asset is measured at the FVOCI in accordance with this one, then the transaction costs are amortized to the P&L using the effective interest rate method. Okay, so in the FVOCI, uh, this is a catch here. This is little bit tricky also. Um, just a minute, I will just frame one example so that you can understand. Like suppose, so in continuation of this one only, so not in this one. So like suppose you have given bank has given a loan to a customer, okay, say 5 lakh rupee for say 3 years, say at uh, say at market rate, uh, say at 10%, okay, and here the bullet repayment is there. So and the market rate is your say 12%, it is going on. So and the transaction cost say 60,000. So for bank, so now the if suppose the fair value it is coming, it will be less than 5 lakh. Why? Because your coupon is less than market interest rate. So here the discount rate it is more than your coupon rate. So so it should be less than 5 lakhs. So suppose if it is coming um, 4 lakh 70,000. Okay, and just taking the this transaction cost as 10,000 only. So it is coming 74 lakh 70,000. Then you need to add the transaction cost here because for the bank it's a financial asset. So it is coming 4 lakh 80,000. Now again you will be calculating the interest rate here, the effective interest rate, because this 4 lakh 80,000 is equal to your 50,000 plus 50,000 plus 50,000 plus 10 lakh. Sorry, 5 lakh. Yeah. So this you will be discounting. So here you will be calculating the effective rate again, interest rate again, that is a discount rate because of this transaction cost. Your transaction cost is added here. Okay, so now suppose effective interest rate it is coming say 11%, 4 lakh 80,000, no? So 4 lakh 70,000 it is 12. If you want 4 lakh 80 higher, so then it should be less than 12%. So like suppose if the effective interest rate it is coming 11% here. Okay. So just I'm assuming it for 11%. So now If you see this 10,000, so so this thing, okay, so 4,80,000. So this amortization. So now what you will be doing? Uh, uh, because this is a little bit complicated to make the example yours, means my um myself. So then it's like means uh, little bit tough also like to uh, prepare the example. So okay, the so how the accounting will be happening? So 4,80,000 plus the interest, the effective interest 11% on this 4,80,000 you will be calculating. So how much it will be coming? So 4,80,000 into your 11%, so it will be coming your interest amount 52800, 52800, and your coupon it will be a 50,000. Okay, so how much the amount it will be coming? 4,82800, and this is your like in continuation this one. So this example it is talking about the FVOCA. So now suppose at the end of the first year your fair value it is say 5,50,000. Okay, 5,50,000. Yeah, this time presuming the fair value is the 5,50,000. Why? Because your interest rate has gone down. So if the interest rate has gone down at the end of the 1 year, so your discounted rate it has gone down. Yeah. So then the fair value it will be higher. So the difference between this one, um, 5,50,000 minus 4,82800, it is coming 6,7,200. So this one, what entry you will be passing for this one? This you will be passing because here the price it has in the fair value it has increased from. So this is your gross carrying amount. This one, and this one is your uh, net carrying amount. You can say the carrying amount, because this amount you will be showing in the balance sheet, not this one, because this is you have classified it under the FVOCA. So this is what I was saying, that if you are listening for the first time, so this is looking little bit odd. So this what you will be passing the entry for this thing. So you will be passing financial asset to OCI because your value has increased. Okay, and this one for this one, what you will be passing the entry? So because this is your asset, so financial asset to P&L for booking the interest, and this one bank account to financial asset. You are receiving the interest amount. Okay, this is the one. And here the catch point is that for the next year, you will be calculating, you will be applying the effective interest rate on this amount. This is the big catch here. This is what I was referring to. So why this FEOC it becomes a little bit complicated, because here this equation is very important. So just try to digest this thing. So I've just, because if you're seeing it for the first time, then it is little bit strange for you also. But yeah, so this is the way it is done, because in the institute this is in the example I haven't seen such type of detail, but yeah, you should know, because here the lot of tweaks are also there, like if the impairment is happening, so then what you will be doing here. So all those things it will be getting it is making more complicated here. So this is your gross carrying amount and this is your carrying amount or your net carrying amount, you can say. Okay, so this, and in the balance sheet you will be showing this amount, not this amount, because you have classified it under the FVOCI. Okay, so this is the thing. So this is what they were. It is saying the transaction costs are amortized to the P&L using the effective interest rate. So here, if you see 4,80,000 to 5 lakh, so this amortization is happening on the basis of this effective interest rate. So that is 11%, and your coupon is 10%. So then 1% you can say it's like your amortization for each year at a very in a simplified manner. Okay, determining the fair value upon the initial measurement. The shareholders of the company C provides the C with the financing in the form of the loan notes to enable it to acquire the investment in the subsidiary. Okay. So what it is doing, the shareholder has given the money to company C, so that company C is using that money to acquire, to do the investment in its subsidiary further. In its subsidiary further, okay. So the loan notes will be redeemed solely out of the dividend received from these subsidiaries and become redeemable only when the C has the sufficient fund to do so. So that means it is not having any life for the repayment, because it is like the redeemable only when the C has a sufficient fund to do so. Yep. So in this context, the sufficient funds refers only to the dividend received from the subsidiaries. Yep. So that means it the C will be redeeming, will be repaying that loan note when it is receiving the dividend from its subsidiary. Yeah. So it is like a chain, like the shareholder, it is giving money to C, and the C is investing it in the subsidiaries, investment in the subsidiaries, sub C. So when it will be giving the dividend, then C will be giving it back to the shareholders of C Limited. Okay, dividend. So repayment here, you will say. Okay, analyze the initial measurement of the loan notes. So in this case, the loan notes are repayable only when the C earns the return in the form of the dividend from the subsidiary, correct? So hence C cannot be forced to obtain the additional external financing, or to liquidate its investment to redeem the shareholders' loan. Consequently, the loan notes are not considered payable on demand. Yeah, accordingly, the loan notes shall be initially measured at their fair value, being the present value of the expected future cash flow. So here uh, 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 you need to predict, like, means when you will be receiving the dividend and when it can be repaid. So discounted using the market related rate. So the amount and the timing of the expected future cash flow should be determined on the basis of the expected dividend flow from the subsidiary, and also the valuation would need to take into account the possible early repayment of the principal and the corresponding reduction in the interest expense. Yeah. So since the loan notes are interest free, or the bear the lower than the market interest, so there will be a difference between the nominal value of the loan notes and the amount granted and their fair value on the initial recognition, because the financing is provided by the shareholders acting in the capacity of the shareholders. So then the difference between the present value and the the nominal value, like the transaction price, it will be acting as an investment. It will be the investment in the C Limited. So the resulting credit should be reflected in the equity as a shareholder's contribution in the C's balance sheet. So in the C's balance sheet, it will be like your uh, equity. And conversely, in the books of the shareholders, the difference between the amount invested and its fair value shall be recorded as an investment in the C Limited. Yeah, so this I was just talking about here. So in the off market, just as a snapshot here, the off market terms, okay, if the parent is giving loan to subsidiary, okay, so then whatever the difference is there, uh, if it's off market, so like the parent is giving the loan to the subsidiary at a cheaper rate, or the interest free, so then whatever the difference is there, that the loan amount minus your fair value, so that difference you will be considering for the parent, in the parent's balance sheet, as the investment. Okay, and in the subsidiary, it will be, the difference will be considered as a equity share capital. Okay, then in the employee, if the company is giving the loan at a cheaper rate, so then the difference, whatever the difference will be coming at the initial recognition, that you will be uh, uh, taking it as for the prepaid service. You can call it as a prepaid service, and then you will be amortizing it on a straight line method during that life of that loan. Okay, and then the next one is it in the lease. where the security deposit is there, the interest free. So then there the difference you are taking it as a raw asset, means prepaid rent or prepaid rent, and then you will be amortizing it on the basis of the straight line method, prepaid rent. So in both you will be amortizing it, but here you are not amortizing it. Okay. So the difference here, it is going in the parent book as investment in the subsidiary, and for the subsidiary it will be like your equity capital you have raised. So equity, share capital equity, and here it is prepaid service, and here it's a prepaid rent. So three types of the off market transactions. Yep. And the fourth one, if it is coming under the level one, then you need to transfer the difference directly in the P&L in the beginning itself. That is at the initial recognition. So this is a story of till now what we have read under the subsequent recognition, yeah, or under the initial recognition. Okay, so use of the cost or the fair value determination of the equity instruments. So Silver Limited has made an investment in the optionally convertible preference shares of a company, Bronze Limited has made an investment. Okay, so this is from the so I think it is talking from the Silver Limited point of view. That means it will be a financial asset. So Bronze Limited at 100 per share and the face value of 100 per share. Yep. Silver Limited has an option to convert these optionally convertible preference shares into the equity shares in the ratio of 1 is to 1, and if such option not exercised till the end of the ninth year, then the shares shall be redeemable at the end of the 10 years at a premium of 20%. So analyze the measurement of this investment in the books of the Silver Limited. Okay, so in the Silver Limited it is talking about. So don't get confused with the CFI, the compounded financial instrument. So this compounded financial instrument, it is from the Bronze Limited point of view, but for the silver, it it is not the CFI. Yep, the classification as assessment for the financial asset is done based on the two characteristics: whether the contractual cash flow comprises the cash flow data SPPA test and the entity's business model for managing the financial asset, whether the company's business model is to collect the cash flow or it involves the cash flow or the sale of the financial asset. In other cases, the financial assets are measured at the FVTPL. So here it's so both the tests are getting failed because the equity is coming into the picture. Okay, so that means the SPPI is not there because it can the holder can exercise this option. So that means the equity share. So and this equity share, it's not your interest in the principal amount. Yeah. So SPPI test is failed, and similarly this uh, this also it is getting failed, the business model test. So that means then it will be going under the FVTPL. So this is what they are trying to say. So in the above case, the holder can realize a return either through the conversion or the redemption at the end of the 10 years. So hence it does not indicate the contractual cash flows that are solely the payment of the principal and interest. Yeah. Therefore, such investment shall be carried at the fair value through P&L. Accordingly, the investment shall be measured at the FVTPL with the gains and the losses recorded in the profit and loss. Okay, accounting for the assets at the amortized cost. So A Limited has made a security deposit whose details are described below. Has made, okay. So this is like your off market transaction, correct? So make necessary general entries for the accounting of the deposit in the first year and the last year. Assume the market interest rate for the deposit for a similar period to be 12%. Okay, so date of the security deposit 1st April X1, and the date of the security deposit finishing date X6. So that means for the 5 years, 2, 3, 4, 5, 6. Yeah, 5 years, and the description lease. Total lease period 5 years. Discount rate 12%. Security deposit 10 lakh, and the present value at the fifth year it is this one. So that is a discounting value. So this is your uh, 1 plus 0.12 raised to the power 5. So this is the discounting value. This is coming. So 10 lakh into this one. So this will be your present value. So the present value it will be coming this one. So then this minus this. Okay. So the 10 lakh minus your present value, it is coming 432,573. Okay, and this what I have told you. So this will be considered under the prepaid rent. So prepaid rent, you can say prepaid rent, or its other name is a ROW, the right of use of asset. So this is what the entry is done here. The security deposit, this one, present value and the difference, and then this is a 10 lakh. And then at the maturity, your security deposit, this one, 567427, this is at the initiation, and this is on the maturity, that is the fifth year. And so this 5,67,427, it will become 10 lakh through the amortization, that is through the effective interest rate, that is 12%. So that means 567427 into 1.12, that is for the first year. Then for the second year it is this thing. Then third year it is this thing. Fourth year it is this thing. Fifth year is this thing, which is equal to your 10 lakh. So this is your amortization, and then you will be receiving the cash. So cash to security deposit at the end of the fifth year, security deposit 10 lakh here. So this is what they're trying to say here. So this is very straightforward, I hope. So see, so this is what they're doing. So this is they are booking the interest. So security deposit to interest income. So this is what I've said here, 567427. This is the initial value into 12% 680,191. So at the fifth year end, it will be a 107. So this whatever the balance it will be at the beginning of the fourth year, then you are multiplying it with the 12%, then it will be coming this much. Okay. So then this will be coming. So I think this is very straightforward. You can also do it yourself. It's just a mathematical thing. Now coming to this one, A Limited invested in the equity shares of C Limited. So accounting for the asset at the FVTPL. Yeah, this is for the FVTPL they are talking about. So A Limited invested in the equity shares of C Limited on 15th March for 10,000. Transaction costs were 500 in addition to the basic cost of 10,000. So this transaction cost, it will be going to the P&L because it's FVTPL. So on 31st March, the fair value of the equity price was 1100 to 11,200, and the market rate of interest is 10% per annum for the 10-year loan. So this is of no use because directly you are measuring at the fair value. So so in the FVOCI it would have been used because there you are in the FVOCI you are following the mixed of it, the amortized cost and then plus doing the equation if you remember. So there you are using the amortized cost and then you are using the gross carrying amount, you are comparing it with the fair value and then you are transferring it to the OCA. So that is a specialty in the FVOCA. So FVOCA it's a mixed approach you can say. But here this it is of no use this one. So directly what you are doing, so the whatever the transaction price is there, you will be charging it to the P&L. Okay, so your fair value at the inception it will be 10,000 only, and then on 31st March it's 1100, 11,200. So that means 1200 you 1100 sorry 1200 gain. So you will be transferring it to the P&L. So FA to P&L you will be doing for 1200. Okay, and for the transactions, this thing. So what the entry will be at the inception. So I was just going a little bit fast, so but yeah, this reducing the speed. So at the inception, what you will be doing? Financial asset to bank. Okay, and the transaction cost also just I'm adding it, just following the same thing. So 10K, then 500, then it is your 10,500. Okay, and then the transaction cost you'll be transferring it to the P&L, 500, transferring it to the P&L, and then at the and means at the thir- on the 31st March, you will be you will be recognizing the mark to market. So then the mark to market, there's an increase in the financial asset value by 1200. So then what you will be doing? Financial asset to P&L, 1200. So by this, your financial asset value will be 11,200, and here its value is 10,000. So transaction cost, so investment in the equity share. So this is like means just have written in the short this thing, the financial asset. But yeah, you can write it as investment. So this is a more appropriate way. Investment in the equity share, 10,000. Transaction cost debited 500. Then to bank 10,500. Then profit and loss to transaction cost 500 500. This is at the on the initial recognition. Then subsequently value has increased. So investment in the equity share of C Limited 1200, and to fair value gain, and this fair value gain to the profit and loss 1200. So directly you can combine these two entries also. So this is also okay. Okay, so now it is coming FEOC. Let's see, this will be interesting. Okay, so here it's a equity instrument. So that means in the equity instrument, this the effective interest rate will not be coming into the picture. So this they have kept it simple. So Metallic Limited has made an investment in the equity instrument of company Castor Limited for 19% stake, significant influence not exercised. The investment was made for uh, just a minute. Okay, the investment was made for 5 lakh, for 5 lakh of 10,000 equity shares on the 1st April. On 30th June, the fair value per share was 45. Okay, so that means the price has reduced from 50, because 5 lakh divided by 10,000, it is coming rupees 50 per share. The company has taken an irrevocable election. Okay, so that means the designation method you have used, they have taken the exception. So it's a long term because of 19% stake. So that means they have taken it as a FVOC instead of the PNL, FVTPL instead of the FVTPL. So what the entry will be at the initial recognition? It will be your um, just I'm writing it in the short form, so maybe you can take it as an investment to bank. This is 5 lakh, 5 lakh. So here there is no transaction cost. Now on 30th June, so investment is reduced. So to investment in the equity instrument of the caster, you can write the full name also by 50,000. So 50,000, and here it will be instead of the PNL, it will be OCI 50,000. Yeah, and this is at the initial recognition. Okay, let's see the example. The solution: the company has made an irrevocable option to carry its investment at the fair value through OCI. Accordingly, the investment shall be initially recognized at the fair value, and all the subsequent fair value gains and the losses shall be recognized in the OCI. Yep. So investment in equity share of the C Limited 5 lakh debited to bank 5 lakhs. So this is same. Okay, then next one, fair value loss on the equity instrument 50,000, 50,000 to investment. Your investment you're reducing it, and then fair value you're transferring it to the OCI. So fair value reserves. So fair value reserve they are using it. So this two entry you can combine and you can call it as a OCI also. So it is not making any difference here. Yep. So this is a booking of the loss of 50,000. Okay, XYZ. So this is now an example of the amortized cost. So XYZ Limited is a company incorporated in India. It provides 10 lakh interest-free loan to its wholly owned subsidiary. So again, it's an off-market transaction. Yep. There are no transaction costs. How should the loan be accounted for in the separate financial statement of XYZ, individual financial statement of ABC, and the consolidated financial statement? Okay, consider the following scenarios. The loan is repayable on demand. So if it is repayable on demand, so then you will be uh, whatever the repayable on demand it is, that amount that you will be taking. So it will be 10 lakh only. Okay, and the loan is repayable after the 3 years. So the current market interest rate for the similar loan is 10%. So here the effective interest rate will be coming. So here you will be calculating the present value and the repayable when the ABC has the fund. So here you need to predict like when the what will be the period in which the time period in which the loan will be repaid. So let's see one by one. Yep. So India's 109 requires that the financial asset and the liabilities are recognized on the initial recognition at its fair value. Yep. As adjusted for the transaction cost. In accordance with the India's 113, the fair value measurement, the fair value of a financial liability with a demand feature is not less than the amount payable on demand. Okay, discounted from the first date that the amount that could be required to be paid. So using the guidance, the loan will be accounted for as below in the various scenarios. So since the loan is repayable on demand, it has a fair value equal to the cash consideration given. So the parent subsidiary recognizes the financial asset and the liability respectively and at the amount of the loan given. So going forward, no interest is accrued on the loan. So upon the repayment, both the parent and the so here there will be no difference because you are recording it at the 10 lakh what the parent company has given the loan. So that's why the difference will not be coming here. So upon repayment, both the parent and the holding will parent and the subsidiary reverse the entries made at the origination. Okay. Now this difference it will be coming in this one the B scenario because here you will be recording at the present value, not at 10 lakh. Okay, so just quickly I will be showing you the calculation. Okay, so here it is 10 lakh. Uh, the market interest rate is your 10%, correct? And this is an interest-free loan. So that means your fair value is not given here. So here the first year no interest, second year no interest, directly you will be getting 10 lakh at the maturity and this you need to discount it. And this 1.1 raised to the power 3. So this one, correct? So it will be coming, I'm just taking the amount from here. It will be coming 751315. So 751315. So in the books of the parent, so parent it is giving the loan to the subsidiaries. So for the parent it will be your financial assets. So to in the separate financial statement it will be to bank 10 lakh. Okay. So the loan to the subsidiary. So that is a financial asset loan to subsidiary subsi 751315 and then the difference whatever the difference it is coming this will be your investment in the parent limited. Similarly in the uh, okay, and in the books of the subsidiary, it will be bank account 10 lakh to financial liability, that is a loan received from the holding company 751315, and then the difference, yeah, 751315, and then the difference, whatever the difference it is coming, it will be to equity. And in the CFS, in the consolidated financial statement, so this is the internal transaction. So all that internal transaction, the inter transaction will get cancelled out. So nothing will be shown here. So this is what they are trying to do. So let's see. Okay. So in the books of the parent limited, so loan to the subsidiary this amount deemed investment. So that is a capital contribution. So that is an investment. Yeah. 24861. So this is a difference between this and this one to bank. And then on this one you will be accruing the interest. So for the accruing the interest loan to ABC, so your loan amount will be increasing. So it will be reaching to 10 lakh at the time of the maturity. So that is your amortization with the help of the effective interest rate. And the effective interest rate is how much it is? The market interest rate, that is your 10%. Yeah, so this is for the 3%. So this 751315, it will be reaching to 10 lakh through the amortization. That means you will be increasing this amount um till the end of the third year, and you will be getting 10 lakh. So this amount will become equal to 10 lakh. So once you have a hold on all these things, the time value of money, so then it's very easy for you to what I'm explaining to you now. So loan to interest income, so 751. So then again for the second year it is this amount. So this will be how it is coming 751315 plus this. Okay, and on this you will be calculating the interest again. Now this 90, how it is coming for the third year, this this plus this, and on that you will be calculating the interest. Yeah, so this will be a gross carrying amount. So just I'm writing here for your simplicity. Okay, that marker is gone. Just a minute, I'm bringing my pen. So 751315 plus you will be accruing the interest at the 10%. So then it is 75131. Here there is no coupon. So that's it's a blank. So then this will be your whatever the amount it is. So it is your um, just a minute. 751315 plus 75131. So it is 826446. So on this you will be calculating the interest again 10%. So it is coming 82645. Okay. So into plus 82645. It is coming 909091. And on this 909091, again you will be calculating the interest, no coupon. Okay. And then it will be becoming equal to 10 lakh. Yeah. So by the end of the third year, if you see at the inception, this was the amount. At the end of the first year, this was the amount 826446. Then at the end of the second year, this amount is 90901, and then 10 lakh. So through the amortization, because here there is no coupon, so that means it is keep on increasing, and you will be reaching it to the 10 lakh, and then this you will be getting the money back. So similarly, what they have done for the it's the other way around. So it is now for the subsidy, it will be your financial liability. So this you can see, it's very straightforward. The entries are same, and this they have shown as a computation here also. Okay. So in the scenario C, what they are saying, um, loan which is repayable when the funds are available. Okay, so that means here there is we don't know the time period by which the subsidy will be refunding the money. So cannot be stated to be repayable on demand. Yeah. Rather, the entities need to estimate. So here you need to apply the estimation. You need to estimate the repayment date and determine its measurement accordingly. If the loan is expected to be repaid in the 3 years, so then it will become a B scenario. Same it is. And in the CFS, the loan and the interest income will be get eliminated because of the intra-group transaction in all the three scenarios. Hence, the above accounting will not have any impact in the CFS, the consolidated financial statement. However, if the loan is in the foreign currency, then the currency fluctuation will be captured in the CFS as per the Ind AS 21. So this is also another tricky point, like we are making it complicated. So like if it is in the FX transaction, if it is there, so then how you will be recording. So I think it will be there in the Ind AS 21. So there we will pick this example of the amortized cost where we will be taking the exchange rate also. Okay. So I think we are good to close now because we have covered a major chunk of this chapter, financial asset. Now, in the next lecture, we will be completing the financial liability, and then the I think two more lectures are required. Let's see how it goes, because my target is like to not to exceed the lecture by more than 2 hours at least. Yep. Okay, thanks. If you like this video, then please subscribe it and please circulate among your friends. Yep. Thank you.